You are paying more for everything, getting less of everything, and working harder than your parents ever did just to stay in the same place. And the data proves it is not in your head. Groceries are up 25 to 30% since the pandemic, and the USDA says they are going up another 3% this year. Beef is up 14% in a single year. A new car costs $50,000, more than the median individual income in this country. Auto insurance has risen 60% since 2018. 1 in 5 car buyers is paying over $1,000 a month just for the car note. Health insurance premiums on the ACA marketplace jumped 22% this year, the biggest spike since 2018, and a family in Kansas watched their premium go from $2,200 to $2,600 a month, while a woman in Arizona went from $94 to $900 overnight because Congress let the subsidies expire. 65% of all personal bankruptcies in America are caused by medical bills. Childcare costs $1,230 a month for one infant, and 1 in 4 parents has left the workforce because they cannot afford the care they need in order to work. Homeowners insurance has doubled since 2020, and insurers are pulling out of entire states. Credit card debt hit $1.28 trillion, the highest ever recorded, at an average interest rate of 22%. Total household debt is $18.8 trillion, 48% higher than the peak before the 2008 crash. Half the country is living paycheck to paycheck. 27% of Americans have zero savings. 88 million adults say they are in financial crisis right now, and the Surgeon General has declared a loneliness epidemic because Americans are too broke and too exhausted to spend time with each other. But here is the number that should keep you up tonight. Harvard researchers published a study in the journal Science and found that in 1940, 92% of American children grew up to earn more than their parents. That was the American dream. It was real. It was measurable. For kids born in the 1980s, that number fell to 50%. A coin flip. And for young men specifically, it dropped to 41%. For the first time in the history of this country, younger generations will earn less on average than their parents did. The escalator that used to carry people upward has stopped. For millions of Americans, it is running in reverse, and nobody is telling you why. Not the politicians who keep saying the economy is strong while you cannot afford groceries. Not the media that reports GDP and stock prices while your credit card balance climbs every month. Not the economists who call it a soft landing while you are in freefall. Go ahead and tell me the last time you walked out of a grocery store and felt like you got a good deal. Tell me the last time you loaded your bags into the car and thought, yeah, that was fair. Because I am willing to bet it has been years. And the reason it feels that way is because it is that way. The USDA's Economic Research Service, which tracks every penny Americans spend on food, reports that food prices in the United States rose 3.1% in the 12 months ending February 2026. Now I know what you are thinking, 3% does not sound like a lot, but that 3.1% is stacking on top of 2.9% in 2025, and 2.3% in 2024, and 4% in 2023, and the absolute gut punch of 2022 when food inflation hit 11.4%, which was the highest since 1979. So when they say prices went up 3% this year, what they are really saying is prices went up 3% on top of the 25 to 30% they already went up since the pandemic started. A Cornell University professor of applied economics named Christopher Barrett told Newsweek something that should be tattooed on the wall of every congressional office in Washington. He said consumers, especially those on fixed low incomes, will face difficult food purchase decisions as food prices rise faster than incomes. Not might face, will face. And if you want to know what that looks like in your specific cart, the USDA breaks it down. Beef and veal prices were 14.4% higher in February 2026 than in February 2025. 14.4% in a single year. Sugar and sweets are predicted to rise 6.7% in 2026. Fresh vegetables are climbing again after a brief dip. Cereal and bakery products, non-alcoholic beverages, processed fruits and vegetables, fish and seafood, all of them are projected to grow faster than their 20-year historical averages. And the average American household is spending roughly $540 a month on groceries in 2026, according to the Bureau of Labor Statistics Consumer Expenditure Survey, with a single adult on the USDA's moderate cost plan paying around $485 a month. For a family of 4 on the thrifty plan, the bare minimum the government considers adequate, you are looking at $950 a month just to put food on the table. $950, and that is the budget plan. That is the plan they base SNAP benefits on. That is the plan that assumes you are cooking every single meal from scratch with basic ingredients and never eating out. That is not living, that is surviving. And here is what nobody wants to say out loud. The prices are not going back down. That is not how inflation works. A researcher at the International Food Policy Research Institute named Joseph Glauber explained it about as clearly as anyone can. He said while food price inflation has slowed from the levels of 2 to 3 years ago, food prices remain high and are not likely to fall back to previous levels. That is the part that politicians do not want you to hear. When they say inflation is coming down, they mean the rate of increase is slowing. They do not mean prices are dropping. Your groceries are not getting cheaper. They are just getting more expensive, a little more slowly, and the gap between what you earn and what your groceries cost is widening every single month. Bank of America Institute data shows that inflation has grown faster than middle and lower income household wages since January 2025. Lower income household wages went up about 2%. Inflation went up 3%, which means every paycheck buys a little less food than the one before it. And it gets worse depending on where you live. Consumer Affairs analyzed grocery inflation by state and found that some areas are being hit 2 to 3 times harder than the national average. Orlando, Florida saw grocery price increases of 6.5% over 12 months, more than double what shoppers in Richmond, Virginia or San Diego experienced. Pennsylvania saw grains, beans, and pasta surge 5.3%, while the same category actually dropped in Colorado. And the reasons behind the price variation are maddening. Labor accounts for half the cost of the food in your grocery cart. Tariffs are making imported fertilizers and fuel more expensive. Immigration policy is creating labor shortages in the food system workforce. And the USDA itself predicts that 8 out of 15 major grocery categories will grow faster than their historical averages in 2026. A researcher at FMI, the Food Industry Trade Association, found that 62% of consumers in January 2026 said they feel very or extremely concerned about rising prices, but that number is actually 6 points lower than a year ago. Not because things got better, because people are getting numb to it. They are accepting that a case of Diet Coke went from $7.88 to $12.88 at Walmart, as one Florida woman told Consumer Affairs. They are accepting that feeding their family costs $1,000 a month. They are adjusting to a reality that would have been considered a crisis 10 years ago. And that normalization of the unaffordable is itself a sign of collapse that nobody is measuring. Owning a car in America has become a financial trap with no exit. If you live in any city in America that does not have a functional subway system, and let us be honest, that is almost every city in America, then you need a car. There is no debate about that. You need a car to get to work. You need a car to get your kids to school. You need a car to buy the groceries we just talked about. In most of this country, a car is not a luxury. It is infrastructure. It is as necessary as running water. And the system has figured out how to make that necessity into one of the most effective wealth extraction tools ever designed. The average price for a new vehicle in 2026 now tops $50,000. Let me say that again because I need it to sink in. $50,000. That is more than the median individual income in this country. You now need to earn more than the average American makes in an entire year just to buy a car off the lot at sticker price. And the financing makes it worse, not better. Buyers are borrowing over $42,000 on average, and nearly 1 in 5 are facing monthly payments above $1,000. $1,000 a month just for the car payment, before you put gas in it, before you insure it, before you fix it when something breaks. Cox Automotive, which tracks every trend in the auto market, ran the numbers for the first quarter of 2026, and their chief economist said something that should terrify every working family in this country. He said this is a great way to show how much prices have risen since the pandemic, and why many consumers no longer feel that owning their own vehicle is within reach. Not an analyst on Twitter. The chief economist of one of the largest automotive data companies in the world is telling you that vehicle ownership is slipping out of reach for ordinary Americans. And the data backs him up. Cox found that since January 2018, auto insurance costs have risen over 60%, not 6%, 60. That outpaces the overall consumer price index by a staggering margin. The average annual premium for car insurance in America is now $2,256, according to the Zebra's 2026 State of Insurance Report, which analyzed over 32 million rates. In Nevada, Louisiana, Florida, Connecticut, and Delaware, average full coverage rates exceed $300 a month. $300 a month just to legally drive the car you are already making a $1,000 payment on. And then there is the part that sneaks up on you after the purchase, after the financing, after the insurance. Maintenance and repair. Cox Automotive's analysis shows that since the pandemic, the cost of vehicle maintenance and repair has climbed nearly as steeply as insurance, approaching a 60% increase. Modern cars are built with advanced sensors, cameras, electric systems, and proprietary technology that cost a fortune to fix. The average car insurance claim now costs around $13,000, according to AM Best, which is a 10% increase from 2024. $13,000 for an average claim. And the Zebra found in their survey that 27% of Americans said they could not afford their car insurance deductible. More than 1 in 4 drivers cannot afford the out-of-pocket cost of making a claim on the insurance they are already paying for. Think about that for a second. You are paying $200, $300, sometimes $400 a month for insurance, and if something actually happens, you cannot afford to use it. That is not insurance. That is a subscription to anxiety, and the subprime auto loan data makes it even darker. Fitch Ratings reported that the percentage of subprime borrowers who are at least 60 days late on their car loans climbed to 6.65% in late 2025, which is the highest level since Fitch started tracking the data in the early 1990s, higher than the peak during the Great Financial Crisis. Car loans are historically the last payment Americans are willing to miss, before the credit card, before the rent, before everything else. People pay their car note because losing the car means losing the job. And when that is the payment that starts going delinquent at record levels, it tells you something about how deep the financial stress has gone. It tells you that people are not just struggling, they are making impossible choices between necessities. And the Insurance Thought Leadership Report put it bluntly when they called it a structural shift, not a short-term spike. Rising repair costs, medical inflation tied to bodily injury claims, litigation trends driving up settlements, supply chain disruptions in parts, skilled labor shortages in repair shops, and increasingly complex vehicle technology that only dealership-certified technicians can service. Every single one of those factors is getting worse, not better. And every single one of those costs gets passed down to you, the driver, the person who has no choice but to own a car because this country was designed around the automobile and never built a viable alternative. You are trapped in a machine that costs more to own every year, in a country that gives you no other option, and the people who profit from that arrangement have zero incentive to change it. Getting sick in America can bankrupt you faster than losing your job. There is a question I want you to sit with for a second, and it is a question that no one in any other wealthy country on earth has to ask. Can I afford to be sick? That is the question that over 100 million Americans are silently calculating every single time they feel a pain they cannot explain, every time a lump shows up where it should not be, every time their child runs a fever that lasts one day too long. Can I afford to go to the doctor? Can I afford the test? Can I afford the treatment? And the data behind that question is so horrifying that it should be a national emergency, and yet we treat it like background noise. Healthcare spending in the United States increased 7.5% between 2022 and 2023, and then another 7.2% between 2023 and 2024. That is not the rate of a system that is getting more efficient. That is the rate of a system that is consuming everything in its path. According to Johns Hopkins, healthcare spending in America now exceeds $15,000 per person per year. Per person. That includes babies. That includes college students who never go to the doctor. Per person. And in any given year, about 20% of the population will experience a major medical event, which Johns Hopkins defines as something costing more than $5,000, and typically $20,000 or more if you end up in the hospital. 1 in 5, every year. And here is the part that makes your stomach turn. An estimated 60 to 65% of personal bankruptcies in the United States are tied to unpaid medical bills. Johns Hopkins researchers confirmed that not credit cards, not student loans, not bad investments, medical bills. Getting sick is the number one way to go bankrupt in this country, and people with medical debt are 5 times more likely to forego mental health care than people without it. So the system breaks your finances, and then the broken finances prevent you from getting help for the psychological damage the system caused. It is a loop, and it is designed to tighten, and the insurance that is supposed to protect you from all of this just became dramatically more expensive. ACA marketplace premiums increased by an average of 21.7% in 2026. That is the largest jump since 2018. KFF, one of the most respected health policy organizations in the world, puts the number even higher at 26%. A web developer in Kansas named Jeremy Tolbert told CBS News that his family's monthly premium went from $2,200 to $2,600 for 2026, and that does not include higher deductibles and out-of-pocket maximums on the same plan. He asked the question that millions of people are asking. He said, "What the hell am I paying for at this point?" And here is why it happened. The enhanced premium tax credits that had been keeping ACA plans affordable for 22 million people expired at the end of 2025 because Congress could not agree to extend them. The government shutdown that dragged on for weeks was partly about this fight, and when it ended, the subsidies were gone. KFF estimates that the 22 million people who relied on those credits could see their plan costs more than double. A woman in Tucson named Kelly Bedo told NPR that her monthly premium went from $94 to an estimated $900. From $94 to $900. That is not an increase, that is an eviction from the healthcare system. A man in Virginia named Chris O'Donnell told NPR his family's monthly premium went from $837 to $2,155. He said he would have to redirect the money he had been saving for retirement to cover the new premium. His exact words were, "This is not the time to be zeroing out my retirement contributions, but what choice do I have?" His wife is a diabetic and a cancer survivor. They cannot go without coverage, so they pay, and they lose their future to protect their present. And for people who get their insurance through an employer, which is the majority of working Americans, it is not much better. The average annual premium for employer-sponsored family coverage reached roughly $29,000 in 2026, with workers paying over $7,000 out of pocket just in premiums before they ever see a doctor. Healthcare costs for employer-sponsored plans are projected to rise 8 to 10% this year. The median premium increase among small group plans is 11%, and the underlying cost of medical care, what insurers call medical trend, is running at about 8% annually, driven by workforce shortages, hospital labor costs, provider reimbursement demands, and the explosion of specialty drugs like GLP-1 medications for weight loss and diabetes that can cost over $1,000 a month per patient. Pedersen KF's latest healthcare trends report found that consumers now identify healthcare as the #1 affordability crisis in America, above food, above rent, above utilities, above everything. And the OBBA made it worse. The new law ends the continuous special enrollment period for low-income people, eliminates tax credit protections that prevented low-income enrollees from having to repay subsidies if their income estimate was off, and cuts $863 billion from Medicaid over a decade. The American Medical Association warned that 10 million people could lose coverage by 2034, and here is the detail that should make you furious. While all of this is happening, while premiums are surging and coverage is shrinking and bankruptcies are mounting, the Pedersen KF Health System Tracker reports that healthcare represents nearly 1 in every $5 spent in the entire American economy. 1 in 5. This is not a system that is failing, because there is not enough money. It is a system that is drowning in money and still managing to leave 100 million people terrified of getting sick. That is not a healthcare system. That is a toll booth between you and your survival. Raising a child in America now costs more than a mortgage in most states. Here is a number that I want every politician who has ever used the word family values to explain. The CARE.com 2026 Cost of Care Report, which surveyed 3,000 parents, found that the average American parent spends 20% of their household income on child care alone. 20%, and that is just child care. When you add in the other caregiving costs that parents are responsible for, including elder care, pet care, and housekeeping, that number climbs to 37% of household income going to care expenses. More than a third of everything a family earns goes to paying someone else to watch their children, their parents, or their home while they are at work earning the money to pay for it. The national average for full-time center-based infant daycare is now $1,230 per month, according to data compiled from the Department of Health and Human Services and multiple industry sources. In Washington, D.C., it exceeds $2,400 a month. In Massachusetts, annual infant care costs between $18,000 and $20,913. The Department of Health and Human Services says childcare is affordable if it costs no more than 7% of a family's income. 7%. The actual national median is 19.3%, nearly 3 times what the government's own standard considers affordable. And it is not just infant care. Toddler care averages $1,080 a month. Preschool averages $920. After-school care for school-age children can run $300 to $600 a month at private centers. A nanny, if you can find one, costs an average of $870 a week in 2026, up 5% from 2024. That is $45,240 a year for one child, before taxes. And the total estimated cost of raising a child from birth to age 18 jumped more than 25% between 2023 and 2025. More than 25% in 2 years. The system is not slowly getting more expensive. It is accelerating away from what normal families can afford. And the response from parents is exactly what you would expect when survival math stops working. 1 in 4 parents has reduced work hours or left a job entirely because of childcare costs or availability, according to a KFF survey. Let that sink in. 25% of parents are scaling back or abandoning their careers because they cannot afford the care they need in order to work. COM found that parents are cutting back on entertainment and leisure, draining their savings accounts, and putting off major expenses just to keep paying for daycare. 95% of parents surveyed said expanded tax credits for care expenses would help. 93% said employers should offer subsidized caregiving benefits. 91% support universal childcare. These are not fringe demands from activists. These are near-unanimous cries for help from the people who are actually raising the next generation. And the Care.com general manager said something that should be etched into the wall of every congressional hearing room in the country. He said parents are not struggling because they are doing something wrong. The system is asking too much of them. When care takes this large a share of household income, it directly shapes career decisions and long-term financial stability. Left unaddressed, the result is a workforce under real strain and families forced into trade-offs that can be hard to undo. And what did Congress do? Under the OBBA, they increased the employer-provided child care tax credit maximum from $150,000 to $500,000 for employers, but the child and dependent care credit for actual families remains capped at $3,000 for one child and $6,000 for 2 or more. That is $250 a month for one child. Daycare costs $1,230 a month. The credit covers about 20% of the cost, and only 1 in 6 families eligible for the federal child care subsidy program actually receives it. 5 out of 6 eligible families get nothing. There are wait lists. There are paperwork barriers. There are not enough slots. And in the meantime, the parents are choosing between their career and their child, between their savings and their sanity, between their present and their future. And the country wonders why fewer people are having children. Your home insurance is about to become the bill that breaks you. I want you to go pull up your homeowner's insurance bill from 2020 and then compare it to what you are paying right now. Because unless you live in one of about 5 states in the country, that number has gone up by 30 to 60% in 4 years, and in some places it has doubled or tripled, and there is no ceiling in sight. Insurify, which tracks insurance pricing data across the entire country, found that the average American homeowner's insurance bill rose 12% in 2025 alone, reaching $2,948 per year. That is up from roughly $1,300 per year in 2020, according to American Express data. So in 5 years, the cost of insuring your home has more than doubled on a national average basis. And in the 5 costliest states, Nebraska, Louisiana, Florida, Oklahoma, and Kansas, homeowners are paying upwards of $4,400 a year. $4,400 just for the privilege of keeping your insurance active. And it is not stopping. Insurify projects another 4% increase nationally in 2026, but the state-by-state numbers are far worse. Georgia is looking at a 10% increase. Illinois, which the governor himself called nothing short of a crisis, saw costs jump about 50% between 2021 and 2024, costing homeowners close to an additional $1,000 per year. Louisiana has seen a 58% increase in rates between 2023 and 2025, the highest of any state. And insured losses from natural catastrophes in the United States average $100 billion a year between 2023 and 2025, up from an annual average of about $15 billion a decade earlier, according to the Insurance Information Institute. $100 billion in insured losses per year compared to $15 billion a decade ago. That is not a trend, that is an exponential curve, and you are the one paying for it. And here is the part that turns a cost problem into a structural crisis. Insurance companies are not just raising your rates, they are leaving. State Farm, the largest home insurer in the country, stopped writing new homeowners policies in California in 2023 and has non-renewed thousands of existing policies. Nearly 400,000 insurance policies have been canceled in California since 2021. After the Palisades and Eaton fires in January 2025, which caused approximately $250 billion in damage and $40 billion in expected insurance payouts, insurers did not step up, they stepped back. In Florida, State Farm denied nearly half of homeowners' hurricane claims in 2022, impacting over 76,000 households. Across the country, small insurers have gone bankrupt after large disasters, leaving policyholders scrambling. When private insurers leave a market, homeowners get pushed onto state-run plans of last resort, like California's Fair Plan or Florida Citizens, which typically offer worse coverage at higher prices. An EDF economist named Carolyn Kowski told the New York Times that insurance is where many people are feeling the economic impacts of climate change first, and she is right, because when your insurance disappears or becomes unaffordable, the entire chain reaction begins. You cannot get a mortgage without insurance. Homes without coverage become unsellable. Property values decline. Tax revenue drops. Schools lose funding. Communities that have stood for decades start to hollow out. And it is happening right now. Not in some theoretical future. Right now, in states across the country. And the most enraging part of all of this is who is profiting from it. A report from Change the Chamber found that major insurance companies like Chubb, Liberty Mutual, and AIG invest heavily in fossil fuel companies. The same industries whose emissions are driving the climate disasters that are destroying homes and generating the claims that insurers use as justification to raise your premiums and cancel your policies. They fund the cause of the crisis on one end and charge you for the consequences on the other. Climate-related damages are now costing the global economy an estimated $16 million per hour. The United States alone spends nearly $1 trillion every year recovering from the impacts of climate change. In 2024, the country sustained 27 separate billion-dollar weather and climate disasters totaling $183 billion in damage. And the insurance industry's response has been to raise premiums, deny claims, drop customers, and leave entire states. LendingTree found that 14% of owner-occupied homes in America are now uninsured entirely, and that number jumped more than 6% from 2023 to 2024, as rising costs pushed more families to gamble. They are gambling that the hurricane does not come, that the wildfire does not reach their street, that the tornado takes a different path, and when that gamble fails, and statistically for millions of people it will, they lose everything. Not because they were irresponsible, because the cost of being responsible became more than they could afford. One member of Congress said in a committee hearing earlier this year that his household insurance had exceeded his mortgage payment. He called it insane. And he is right, it is insane. But insane has become the price of keeping a roof over your head in America in 2026. You are drowning in debt, and the water is still rising. The Federal Reserve Bank of New York published its household debt and credit report for the fourth quarter of 2025 in February 2026, and the number at the top of the page should have been a national headline. Total household debt in the United States reached $18.8 trillion. I am going to let that number breathe for a second because I do not think most people understand how staggering it is. $18.8 trillion. That is 48% higher than the previous peak of $12.7 trillion set in the third quarter of 2008, right before the entire financial system collapsed. We are now carrying nearly half again as much debt as we were at the exact moment that the last crisis began. And the breakdown tells you everything about what is happening to everyday life in America. Mortgage debt totals $13.17 trillion. Auto loan debt stands at $1.67 trillion, with the average monthly car payment hitting a record $742, according to Experian. Credit card debt reached $1.28 trillion, the highest balance since the New York Fed began tracking it in 1999. That is up $507 billion, a 66% increase from the pandemic low in early 2021. Student loan debt sits at $1.65 trillion, increasing at 2.5% annually. And personal loan balances hit $597.6 billion, growing 7.6% in a single year, as consumers increasingly take out loans to pay off their more expensive credit card debt. For the first time ever, non-mortgage consumer debt, meaning credit cards, auto loans, and student loans combined, exceeds $5 trillion. Let me say that differently so you feel it. Americans owe more than $5 trillion on things that are not houses. And the average American carries $104,755 in total debt, according to Experian. That is the weight you are dragging behind you every single day. And the interest rates on that debt are where the system goes from burdensome to predatory. The average credit card APR is now in the 21 to 22% range, according to the Federal Reserve, up from roughly 15% before inflation took off. If you carry the average credit card balance of $6,580, which is a record high according to Elite Personal Finance and Experian data, you are paying over $1,400 a year in interest alone just to stand still. And since 2010, Americans have collectively paid $2.1 trillion in credit card interest. $2.1 trillion. That is more than the entire outstanding student loan balance. More than the entire auto loan balance. It is a transfer of wealth from working households to financial institutions that has been so gradual, so constant, so normalized that it never makes the front page. And 55% of people with credit card balances told an Achieve survey that they are using their cards to cover necessities, not luxuries. Groceries, utility bills, gaps in rent. The credit card has become the last line of defense between a household and a genuine crisis. And the median utilization rate for borrowers with the lowest credit scores has reached 99.2%, according to TransUnion. There is almost no credit left, the runway is gone, and the delinquency data confirms it. The New York Fed reports that 4.8% of all outstanding household debt is now in some stage of delinquency, the highest rate since before the 2008 financial crisis. Auto loan delinquencies are approaching levels not seen since that crisis, and car loans are historically the last payment people are willing to miss because losing the car means losing the job. When that payment starts going delinquent at record levels, it tells you the distress is not at the edges, it is in the center. It is in the lives of people who are doing everything right and still losing ground. And here is the part that ties this entire section together and connects it to everything else in this video. You are not in debt because you are irresponsible. You are in debt because the cost of existing in this country has outpaced your income for years, and the gap keeps widening. Your groceries cost 25 to 30% more than they did 4 years ago. Your car insurance went up 60%. Your health insurance jumped 22% in a single year. Your childcare eats 20% of your household income. Your rent or mortgage takes another 30 to 40%. And your wages, if you are in the lower or middle income bracket, have not kept pace with any of it. So you put the difference on a credit card. And the credit card charges you 22% interest for the privilege of surviving. And the banks that issue those cards, the same banks that receive bailouts funded by your tax dollars in 2008, have increased their profit margins on credit card lending by over 109% since the financial crisis. They are making more money from your desperation than they have at any point in modern history. And during his campaign, President Trump proposed capping credit card interest rates at 10%, which would have provided meaningful relief to the 27 million Americans who are only making minimum payments. That proposal has not materialized. It has not even been introduced as legislation. Because the financial institutions that profit from your debt are the same institutions that fund the campaigns of the people who could change the rules. That is not a conspiracy. That is a business model, and you are the product. Your debt is the revenue. Your stress is the cost of doing business. And nobody in Washington is coming to rescue you because your monthly minimum payment is someone else's quarterly earnings. Americans are more alone than at any point in modern history, and it is killing them. Everything I have talked about so far in this video, the groceries, the insurance, the car payments, the medical bills, the child care, the debt, all of it has a consequence that nobody is measuring on a spreadsheet. It is hollowing out the social life of this country. It is making Americans too broke, too exhausted, and too afraid to spend time with each other. And that erosion of human connection is not just sad. According to the United States Surgeon General, it is a public health crisis on par with smoking. In 2023, Surgeon General Vivek Murthy issued an 82-page advisory declaring an epidemic of loneliness and isolation in the United States. He said that even before the pandemic, approximately half of American adults were reporting measurable levels of loneliness, half the country. And his advisory contained a finding that should have rewritten public health policy in this country overnight. Loneliness and social isolation increase the risk for premature death to levels comparable to smoking 15 cigarettes a day. A 29% increased risk of heart disease, a 32% increased risk of stroke, a 50% increased risk of developing dementia for older adults. This is not about being sad. This is about dying younger, because you do not have enough meaningful human contact. And the data since that advisory has only gotten worse. A January 2026 national survey found that approximately 41% of Americans experience loneliness. Harvard's Making Caring Common project found that 21% of adults feel lonely, with 65% of lonely respondents saying they feel fundamentally disconnected from others or the world. And 58% of Americans say they feel like nobody truly knows them. Not misunderstood. Invisible. More than 2/3 of Americans never participate in clubs or organizations. Never. And the researcher who led that study said something chilling. She said it is not just that we are feeling alone. We are objectively alone, and to an even larger extent than expected. And here is the detail that connects this back to everything else in the video, and explains why the loneliness epidemic is not a separate crisis, but a symptom of all the others. Fortune reported in March 2026 that Americans are skipping social events because they cannot afford them. The CFP board surveyed over 1,100 Americans and found that people are turning down invitations to hang out with friends because they do not have the money. And 56% of them never told their friends that money was the reason. They just stopped showing up. They withdrew. They disappeared from their own social lives because the cost of dinner or drinks or a movie had become more than their budget could absorb after paying for groceries and gas and insurance and debt. A Reddit user captured it perfectly when they posted lately, "I have been turning down invites to hang out because I just cannot afford it, and it is starting to make me feel guilty. I do not want my friends to think I do not care about them, but even small things like dinner or drinks add up too much right now." That is the intersection of every single crisis we have talked about. The cost of living is not just taking your money, it is taking your friendships, your community, your sense of belonging, and the American Time Use Survey data shows it plainly. Adults spent 5.5 hours a week socializing in 2003. By 2019, that was down to 4.5 hours. By 2021, it had dropped to 4 hours, and it has not recovered. For every additional hour Americans spend at home, they spend 21 more minutes alone, but 5 fewer minutes with friends. Young people aged 15 to 24 have seen a 70% reduction in social interaction with friends. Close friendships have cratered. In 1990, nearly half of Americans had at least 6 close friends. Today, that number is about a quarter. 2 in 10 adults have no close friends outside of family at all. In 1990, only 3% said that, and the infrastructure that used to hold communities together is disappearing at the same time. Just under half of Americans belong to a religious congregation in 2023, a record low since Gallup started tracking it in 1937. Only 10% of workers are in a union, down from 20% 4 decades ago. About half of Americans regularly spent time in a public space like a coffee shop or park in 2025, down from 2/3 in 2019. Only about a quarter of Americans say most people can be trusted, down from about half in 1972. And 8% of Americans have no close friends at all, according to Pew. The places where people used to find each other, the churches, the bowling leagues, the neighborhood bars, the union halls, the civic organizations, they are either gone or shrinking, and nothing has replaced them. Social media was supposed to connect us, and instead it replaced depth with performance. The Surgeon General himself said that what began as an effort to build community has rapidly transformed into something that is actively contributing to loneliness. And a society of isolated, disconnected, distrustful people is not a society that can solve the problems we have been talking about in this video. You cannot build affordable housing if neighbors cannot agree on what their community needs. You cannot reform healthcare if voters are too disengaged to pressure their representatives. You cannot fix the tax code if citizens do not trust each other enough to organize. Loneliness is not a personal failing. It is the final symptom of a system that has commodified every hour of your day, priced you out of the activities that used to create connection, exhausted you with work and debt and survival, and then blamed you for being alone. The collapse of everyday life in America is not just economic. It is social, it is spiritual, and it is happening in the space between people who used to know each other's names. Americans are not living anymore, they are just surviving. I want you to think about the last time you did something for no other reason than joy. Not productivity, not obligation, not because someone was paying you or expecting something from you, just joy. A road trip with no destination, a dinner with friends where nobody looked at the bill, a Saturday where you did not check your bank account, did not calculate how many hours of work it would take to cover what you just spent, did not feel that low hum of guilt for enjoying something while your credit card balance sat unpaid. Because for a growing number of Americans, that kind of experience has become a memory. Ramsey Solutions surveyed the state of personal finance in America and found that 52% of adults worry daily about their finances. Daily. Every single morning, more than half the country wakes up with money as the first thought in their head. 34%, 88 million adults, say they are struggling or in crisis with their finances right now. 45% report some difficulty paying their basic bills. 37% are having difficulty providing food. 57% of renters have had some difficulty making rent in the past 3 months, a 15-point jump in 2 quarters. And 35% of Americans say they feel trapped in a cycle of debt that they cannot escape. Not struggling, trapped. There is a difference between those words. Struggling implies motion, implies effort, implies the possibility that things might get better if you try harder. Trapped implies a system that does not let you out no matter what you do. And that is the word 1 in 3 Americans chose to describe their own financial life. And when surviving is all you can manage, living is the first thing you cut. You stop going out. You stop saying yes to invitations. You stop taking vacations. You stop putting money into retirement. You stop going to the doctor because you cannot afford the copay. You stop pursuing the degree because you cannot take on more debt. You stop having children because you cannot afford daycare. You stop dreaming about a house because the math does not work. You start measuring your life not in milestones but in payments, not in memories but in balances, not in how you feel but in what you owe. Civic science found that 76% of Americans have little to no financial safety net, with 21% of regular paycheck recipients reporting they have zero funds remaining after covering their expenses. Zero. Nothing left. And 55% say they have only a little left over. Bankrate found that 27% of Americans have zero emergency savings, the highest level ever recorded. 59% cannot cover a $1,000 emergency expense with savings, a flat tire, a broken tooth, a car that will not start. Any one of those things on any given Tuesday can send a quarter of the country into financial crisis. And the people who study this call it a survival mode mentality. They are not being dramatic. Civic science used that exact phrase, survival mode, because that is what it is. You are not building a life. You are defending a position. You are not moving forward. You are bracing for impact. And here is what makes this section the most devastating one in the entire video. The majority of Americans know that this is happening, and they still believe it can get better. Ramsey found that 79% of Americans are at least somewhat optimistic about their financial future. 67% feel positive about 2026. But only 38% are confident in their ability to save for retirement. Only 20% feel like they are actually getting ahead. And 41% say they would rather enjoy life now than save for the future. Not because they are reckless, but because saving feels pointless when every dollar you set aside gets swallowed by the next bill, the next premium increase, the next price hike at the grocery store. They are choosing the present because the future has been priced out of reach. And that is the collapse I am talking about in this video. It is not a stock market crash. It is not a bank failure. It is not a headline event that happens on one day and makes everyone gasp. It is the slow, steady erosion of everything that makes a life worth living. The meals you cannot afford, the friends you cannot see, the doctor you cannot visit, the home you cannot buy, the retirement you cannot fund, the children you cannot raise, the community you cannot find. It is happening one payment at a time, one bill at a time, one declined invitation at a time. And the most dangerous part is that it has been happening so slowly that most people do not even recognize it as collapse. They think it is just life. They think this is normal. It is not normal. It is what happens when a country decides that the economy is more important than the people inside it. And the people inside it are paying with everything they have. The American dream did not fail. It was mathematically eliminated. Your parents told you that if you worked hard, played by the rules, got an education, and kept your head down, you would do better than they did. That was the promise. That was the entire premise this country was built on. The idea that each generation climbs higher than the last, that the tide lifts all boats, that America is the place where it does not matter where you start because what matters is where you finish. And I am here to tell you, with data published in one of the most prestigious scientific journals on the planet, that the promise is broken, not bending, not strained, broken. Researchers at Harvard's Opportunity Insights, led by economist Raj Chetty, conducted a landmark study that was published in the journal Science, and their central finding is one of the most important numbers in modern American history. For children born in 1940, more than 90% grew up to earn more than their parents, 92% to be exact under their benchmark model. The American dream was not a myth for that generation. It was a mathematical near certainty. If you were born in 1940, there was a 92% chance you would out-earn your parents. But for children born in the mid-1980s, that number collapsed to 50%. A coin flip. Half the generation will do better than their parents. Half will not. And when you isolate sons compared to their fathers, it is even worse. The rate drops from 95% for those born in 1940 to 41% for those born in 1984. 41%. Less than half of young men in America will earn more than their fathers did. That is not a slowdown. That is a reversal of the most fundamental promise this country ever made. And here is the part that should end every debate about whether the problem is effort or structure. The researchers ran simulations to figure out what could reverse the decline. They found that if you restored GDP growth to the levels experienced in the 1940s and 1950s, but kept the current distribution of that growth, meaning the same level of inequality, absolute mobility would only climb back to 62%. Growth alone is not enough, because a large fraction of GDP today goes to a small number of high-income earners. The growth happens, it just does not reach you. But if you kept GDP at its current level and simply distributed it more equally, the way it was distributed for children born in the 1940s, mobility would jump back to 80%. That reverses more than 2/3 of the entire decline. The study concluded that to restore mobility under today's income distribution, you would need sustained real GDP growth above 6% per year, which has never happened in the post-war history of the United States. It is mathematically impossible to restore the American dream through growth alone under the current system. The only way to bring it back is to change who the growth reaches, and that is not happening. It is going in the opposite direction. The Gini coefficient, which measures income inequality on a scale from 0 to 1, currently sits at 0.434 in the United States, the highest of any G7 country. The top 1% hold 31% of all wealth, while the bottom 50% hold 2.5%. And international comparisons make it even more damning. Researchers compared the United States to 7 other high-income countries and found that more than 75% of Norwegian children out-earn their parents. In the Netherlands, it was nearly 80%. In Finland, Sweden, and the United Kingdom, it was between 65 and 75%. Denmark, which has lower pre-tax mobility than the United States, reaches 67% after taxes and social transfers, because their system is designed to cushion the fall. The American system is not. Miles Korach's work found that social mobility in Germany is 1.5 times greater than in the United States. Canada is 2.5 times greater. Denmark is 3 times greater. The United States and the United Kingdom are the least mobile societies among the rich countries studied. The land of opportunity has the least opportunity. That is not an opinion. That is peer-reviewed, replicated, internationally verified economic data. And a Wall Street Journal survey from September 2025 found that nearly 70% of Americans now say they believe the American dream no longer holds true or never did. That is the highest level in nearly 15 years of surveys. 70%, and for the first time in United States history, younger generations will actually earn on average less as adults than their parents did. Not adjusted for cost of living. Not in certain categories. On average, less. The escalator that used to carry people upward has stopped. And for millions, it has started moving in reverse. The middle class, which was 47% of the population in 1967, shrank to 36% by 2016. And while some of that shrinkage moved into the upper middle class, much of it simply dispersed into a growing underclass of people working full-time and falling behind. Wages for non-supervisory workers, corrected for inflation, are at roughly 85% of what they were in 1973. You read that correctly. The average worker today makes less in real terms than the average worker did more than 50 years ago. And health and education costs have risen more than 160% since 1998, while overall inflation totaled 59%. The things that are supposed to lift you up, a degree in your health, are the things that are burying you the deepest. The American dream was not killed by laziness or avocado toast or whatever condescending explanation the comfortable class likes to offer. It was killed by a distribution system that sends the rewards of economic growth to the top and sends the bill to everyone else. And every single number I have cited in this section has been published by Harvard, by the journal Science, by the Census Bureau, by the Wall Street Journal, and by the World Economic Forum. This is not a conspiracy theory. This is the documented, measured, peer-reviewed autopsy of a national promise. The system is not broken. It is working exactly as designed. I have spent this entire video walking you through the collapse of everyday life in America. We started at the grocery store, where feeding your family costs $1,000 a month and the prices are not going back down. We moved to the car, where owning a vehicle now costs more than the median individual income, and insurance has risen 60% in 6 years. We walked through the healthcare system, where getting sick bankrupts more families than any other event and premiums jumped 22% in a single year, while Congress let the subsidies expire. We looked at childcare, where parents spend 20% of their income on daycare and 1 in 4 has left the workforce because they cannot afford the care they need in order to work. We examined the insurance crisis, where your home insurance has doubled since 2020 and companies are leaving entire states, We pulled apart the debt machine, where $18.8 trillion in household debt sits on top of 22% credit card interest rates, and banks have increased their profit margins by 109% since the last crisis. We talked about the loneliness epidemic, where half the country is measurably lonely and people are skipping social events because they cannot afford dinner with friends. We watched Americans shift from living to surviving, where 88 million adults say they are in financial crisis and a quarter of the country has zero emergency savings. And we traced the death of the American dream, where the chance of out-earning your parents has fallen from 92% to 50%, and younger generations will be the first in American history to earn less than their parents did. And now I need to tell you the hardest truth of all. None of this is an accident. The grocery prices are not high because of bad luck. They are high because labor is underpaid, tariffs are raising input costs, and corporate profit margins in the food industry have expanded even as wages stagnated. The car you cannot afford is not expensive. By coincidence. The auto industry shifted to SUVs and trucks with higher margins while cutting affordable sedans, and the financing system is designed to stretch payments over 7 years, so the sticker shock is hidden in monthly installments that eat you alive over time. The healthcare system does not bankrupt people because it ran out of money. It spends more per person than any country on earth and still leaves 100 million people terrified of getting sick because the money goes to executive compensation, pharmaceutical profits, and administrative bloat. The childcare system is not underfunded because America is poor. It is underfunded because the people who write the budgets decided that tax cuts for the wealthiest fifth of families were a higher priority than making it possible for working parents to afford care for their children. The insurance companies are not raising your rates because they are struggling. They are posting record profits while simultaneously investing in the fossil fuel companies whose emissions are driving the climate disasters they use to justify your premium increase. And the debt you are carrying at 22% interest is not a personal failure. It is a revenue stream. Banks made $2.1 trillion in credit card interest over the past 15 years. Your desperation is their business model. Every crisis I described in this video has a beneficiary. Every cost you absorb is someone else's income. Every service you can no longer afford was priced that way on purpose. And this is why I called this video Everyday Life in America is Collapsing. Because it is not one thing, it is everything. It is the grocery bill and the car payment and the insurance premium and the medical debt and the childcare and the rent and the loneliness and the exhaustion, all arriving at the same time, all feeding each other, all accelerating in the same direction, while the people who profit from the arrangement tell you that the economy is strong and the stock market is up and unemployment is low and everything is fine. Everything is not fine. The stock market is up because corporations are posting record profits by charging you more for less. Unemployment is low because people are working 2 and 3 jobs to survive. GDP is growing because the government is borrowing $7 billion a day to fund a sugar high that the CBO says will not last. The metrics they use to tell you the economy is healthy are not measuring your life. They are measuring the life of the economy. And those are two very different things. Your life is measured in whether you can afford to eat, whether you can take your kid to the doctor, whether you can see your friends without checking your bank account first, whether you can imagine a future that is better than your present. And by those measures, for tens of millions of Americans, everyday life is collapsing. Not in a dramatic, cinematic, headline-grabbing way, in the quiet way, in the putting something back on the shelf way, in the staying home instead of going out way, in the checking your balance before buying gas way, in the way that nobody talks about because everyone assumes it is just them. It is not just you, it is the system. And the system is not broken. It is working exactly as designed. The question is who it was designed for. And if you have watched this entire video, you already know the answer. I know this was a heavy video. I know it is a lot to take in at once. And I know that when you hear this much bad news stacked together, the temptation is to shut down, to tell yourself there is nothing you can do, to scroll past it and go back to whatever was making you feel normal 5 minutes ago. But I did not make this video to leave you there. I made it because the first step to protecting yourself is understanding what you are up against. And now you do. You understand that the cost of living is not coming down. You understand that the system rewards the people at the top and bills the people in the middle. You understand that the loneliness you feel is not a personal failing, but a structural consequence of a country that has priced community out of reach. And you understand that the American dream, as it was originally promised, has been mathematically eliminated by the way growth is distributed. But knowing that does not mean giving up. It means making different decisions with your eyes open. It means building the tightest budget you can and defending it. It means calling your friend back even when you think you cannot afford dinner, because connection is not a luxury, it is survival. It means showing up at the school board meeting, the city council, the town hall, because the people making the decisions that shape your daily life are counting on you being too tired to care. It means sharing what you know with the people around you, so they stop blaming themselves for a system that was never designed to serve them. This video was the truth as I understand it. Every number was sourced, every claim was backed by data. If it changed how you see things, share it with one person who is going through it right now and does not know why. Take care of yourselves, take care of your families, and I will catch you in the next one.